breaking. Gold just triggered the exact same signal as 1971. There is a moment in history when the rules change. Not slowly, not gradually, not in a way that gives you time to adjust. There is a moment when everything that was true yesterday suddenly isn't, and the people who saw it coming look like geniuses, and the people who didn't lose decades of wealth in a matter of months. We are living inside one of those moments right now. And what makes this one so extraordinary, so genuinely different from every other market event you've heard hyped in the last few years, is that it has happened before. Almost exactly. And the last time this particular signal fired, gold went on to do something so dramatic, so historic, that most people still struggle to believe the numbers. I want to take you back, because understanding what happened then is the only way to understand why what's happening right now is so significant. Let's talk about 1971. Not the music, not the politics, but the monetary architecture. For 25 years after World War II, the global financial system ran on what was called the Bretton Woods Agreement. Every major currency in the world was pegged to the US dollar, and the US dollar was pegged to gold at a fixed rate. The whole thing was a promise, a contract between nations. The United States essentially told the world, trust our paper, because our paper is backed by something real. Every dollar in circulation had gold standing behind it. Foreign governments could walk up to the Federal Reserve window and hand over dollars, and they would receive physical gold in return. That was the deal. Now, here's what went wrong, and pay attention because this is where the parallel to today gets uncomfortably precise. By the late 1960s, the United States was running massive deficits. The Vietnam War was bleeding the treasury dry. Domestic spending programs were exploding. The government was printing dollars faster than the gold reserves could justify. Foreign nations started to notice. France, under Charles de Gaulle, made the move first. They started sending dollars back and demanding gold. Other nations followed. The gold was draining out of Fort Knox at an alarming rate. The United States was exposed. The promise was a lie. There wasn't enough gold to back all the dollars that had been printed, and the world was starting to figure that out. So on August 15, 1971, Richard Nixon went on television and did something that had never been done before. He closed the gold window, just like that. The dollar was no longer convertible to gold. The contract was broken. The anchor was cut. Every currency on Earth was suddenly floating on nothing but faith in governments and central banks. And what did gold do the moment that anchor was cut? It exploded. Over the next 9 years, gold rose over 2,000%. From $35 an ounce, it climbed all the way to $850. Silver was even more dramatic. People who had positioned themselves correctly became wealthy almost beyond imagination. People who hadn't seen it coming watched their savings evaporate in the inflation that followed. Now, let me tell you about the signal that just triggered, the one that is virtually identical to the conditions that existed just before Nixon made that fateful announcement. Before I get into this, quick note. If you're watching this and you're approaching retirement or already in it, I put together a free guide in the description below. It's called something like the Retiree's Wealth Protection Blueprint. It covers the exact saving strategies that thousands of American retirees are already using to protect their hard-earned wealth from what I'm about to describe. It's free. Just check the description. Okay, back to the story. The signal that fired in 1971 wasn't just a chart pattern. It wasn't some technical formation that traders use to predict short-term price moves. It was something deeper. It was a confluence of forces, monetary, geopolitical, institutional, all converging at the same time, all pointing in the same direction, all whispering the same thing. The system is broken, and the market knows it. Here is that confluence happening again today. First, the monetary architecture. Back in 71, the United States had printed far more dollars than it had gold to back. Today, the United States has accumulated a level of national debt that is staggering beyond historical precedent. We're talking about obligations so large that the interest payments alone are now one of the biggest line items in the federal budget. The government is spending more on interest than it spends on defense. Think about that. More on debt service than on the military. And that number keeps climbing because the debt keeps climbing. There is no credible plan to reduce it. There is no political will to make the cuts necessary. The only tool left is the same one they used in 71, debasement, making each dollar worth a little less by creating more of them. The difference between today and 71 is that today there is no pretense of a gold backing. We went off gold completely 50 years ago. So there's nothing limiting how many dollars can be created except the willingness of the world to keep accepting them. And here's where it gets really interesting, because that willingness, it's starting to crack. You've heard about de-dollarization. Maybe you've heard it and thought it was some fringe theory. Let me give you something concrete. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of additional members, have been systematically reducing their reliance on the US dollar for international trade. China and Russia are conducting their bilateral trade entirely outside the dollar system. Saudi Arabia, for decades the anchor of the petrodollar arrangement, has begun accepting yuan for oil sales. India is paying for Russian energy in rupees. The architecture of dollar dominance that has existed since Bretton Woods is eroding. Not overnight, not in a crash, but steadily, methodically, deliberately. And what are these nations accumulating as they move away from dollars? Gold. Central bank gold buying has been running at record levels. Not in some quiet trickle. We're talking about the most aggressive accumulation of physical gold by sovereign governments in modern recorded history. China has been adding to its official reserves consistently and dramatically. Poland bought massive quantities. Czechia, Hungary, India doubled its reserves. Turkey. These aren't small, speculative plays. These are governments making a strategic decision that in the monetary system that's coming, the one replacing the dollar-dominated order, gold will matter again, just like it mattered before 1971, just like it always has mattered throughout 5,000 years of human civilization. Think about what that tells you. These are the people with the best intelligence on the planet. They have access to information that retail investors will never see. They have teams of economists and analysts running scenarios, and they are choosing to move out of dollars and into gold. That is not a coincidence. Now, let's look at the second layer of this signal, the COMEX mechanics, because this is where it gets technical, but stay with me, because it explains something about gold's current trajectory that almost nobody outside of institutional finance fully understands. The COMEX is the primary futures exchange in New York where gold is traded. For decades, it has operated on a system where vastly more gold is traded in paper form than actually exists in physical form. The ratio of paper gold to actual physical gold in the vaults has historically been enormous, sometimes over 100 to 1, meaning for every bar of physical gold sitting in the COMEX warehouse, there are dozens or even hundreds of contracts representing claims on that gold. For a long time, this worked because most participants never asked for delivery. They were financial players, hedge funds, banks, trading paper gold back and forth, taking profits, without any intention of actually taking possession of the metal. That is changing. And it started changing in a way that mirrors what happened when foreign nations started showing up at the Fed window demanding actual gold in exchange for dollars. Physical gold has been draining from COMEX and LBMA vaults at an accelerating rate. Participants who were previously happy to roll their futures contracts are now demanding delivery. Some of this is driven by the tariff concerns that created a geographic arbitrage between London and New York prices. Some of it is driven by institutions in Asia who have decided they want the metal, not the promise. Some of it is driven by a growing awareness that in a world where financial counterparty risk is elevated, where banks can fail, where exchanges can be frozen, where governments can seize assets, there is a category difference between holding a paper claim on gold and holding the actual metal. When the paper claims start being called in against a limited physical supply, something has to give. Either the price adjusts violently upward, or the system acknowledges it cannot deliver. Either outcome tells you everything you need to know about where gold is headed. Here's the third layer. The institutional behavior that preceded the 71 explosion had a very specific fingerprint. There was a period of skepticism, followed by a period of quiet accumulation, followed by a sudden shift in public positioning. The smart money moved first, quietly. Then the money that followed the smart money moved. Then public awareness caught up, and the final explosive phase began. We appear to be in that middle phase right now. The smart money has moved. The central banks have moved. The institutional allocation to gold has shifted meaningfully, and the public, the retail investor, the person with the 401k or the IRA who is still 80% in stocks and bonds, largely hasn't moved yet. That gap between institutional positioning and retail positioning is historically enormous, and historically, it doesn't stay large forever. Gold has already made dramatic moves from where it was trading just a few years ago. From the lows, it has climbed to levels that would have seemed impossible to many analysts at the time. And yet, if you look at the historical trajectory after 1971, this may be early days. After the gold window closed, it took years for the full move to play out. The investors who sold too early, who looked at a 50% gain and said, good enough, missed the bulk of the move. The investors who held through the volatility and understood what was actually happening, the fundamental monetary shift that had occurred, those were the people whose stories got told a generation later. Let me put a different frame on this. Imagine you're a ship's captain and you've been navigating by a lighthouse for your entire career. That lighthouse has always been there. Every captain uses it. The whole system of sea lanes, the insurance models, the harbor schedules, everything is built around that lighthouse. And then one night, the lighthouse goes dark. Not because the seas got calmer, not because the ships got better, just because the people running the lighthouse decided to turn it off. What happens in the ocean that follows? Ships that adapted quickly found new stars to navigate by. Ships that kept looking for the old light ran aground. The lighthouse in this story is dollar-backed monetary stability. It has been the orienting mechanism for global finance since the end of World War II. And right now, it is flickering in ways that look very much like it did in the months before August of '71. Now let me take you to the geopolitical layer, because this is the one that makes the 71st parallel almost eerie. In '71, the United States was overextended militarily, running twin deficits, facing an erosion of its credibility as a global guarantor. The world was losing faith not just in the dollar, but in the American-led order that backed it. Sound familiar? Today we have a global realignment happening at a speed and scale that hasn't been seen since the post-World War II reorganization. Alliances are shifting, trade blocs are forming outside of American-led institutions. The International Monetary Fund, the World Bank, the SWIFT financial messaging system, all of these have been weaponized as geopolitical tools. And every time they are weaponized, more nations accelerate their search for alternatives. Russia was cut off from SWIFT. Iran was cut off from SWIFT. Each time it happened, 20 other nations looked at that and thought, that could be us. What's our backup? For many of them, the answer has been gold. Physical gold, held domestically outside the reach of foreign sanctions. Gold that cannot be frozen with a phone call from Washington. Gold that has been a store of value and a medium of exchange for 5,000 years, regardless of which empire was dominant. Here's something that doesn't get talked about enough. The historical relationship between gold and purchasing power over centuries is extraordinary. A Roman centurion was paid a salary that, converted to gold and converted back to today's prices, would be roughly equivalent to a modern soldier's salary. Gold has maintained purchasing power across millennia in a way that paper currencies simply have not. Every paper currency in history has eventually returned to its intrinsic value, which is the cost of the paper and ink. Gold has never done that. Not once. I want to bring this to a more personal level, because all of this analysis, the COMEX mechanics, the central bank buying, the de-dollarization, the 71 parallels, it matters to you in a very specific way if you are approaching retirement, or if you are already in retirement, or if you have spent decades building up a nest egg that is currently sitting in assets denominated in dollars. Think about what happened to the purchasing power of the dollar in the decade that followed Nixon's '71 announcement. Inflation went to levels that Americans had never experienced in modern times. The price of groceries, utilities, gasoline, housing, everything repriced dramatically. People who had saved carefully in dollar-denominated instruments saw the real value of their savings carved away year after year. A retiree who had done everything right, worked hard, lived modestly, saved diligently, could find themselves watching their careful plans come undone, not through any failure of their own, but because the monetary system underneath them had shifted. Gold was the alternative. The people who owned gold in 1970, 1971, who had positioned even a portion of their wealth in physical precious metals, experienced the opposite. Their wealth was preserved, in some cases dramatically increased. While their neighbors were tightening their belts, they were sleeping well. And this brings me to something I want to mention for those of you watching who are sitting on significant retirement savings, $100,000 or more in an IRA or 401k, money you've been building for years and years. There's a way to get physical gold into a retirement account. Not an ETF, not a futures contract, not a piece of paper that says you own gold somewhere. Actual physical gold, held in a proper custodial arrangement. inside the structure of your existing retirement account with the same tax advantages you already have. It's called a gold IRA, and the mechanics of setting one up are not as complicated as most people assume. The reason more people haven't done it is largely just lack of awareness. They don't know it's possible. I put information about this in the description. It's worth at least understanding how it works and whether it makes sense for your situation. In a world where everything I've just described is unfolding in real time, having even a portion of your retirement assets anchored in something that no government can print into worthlessness is not a fringe idea. It's what the central banks of the world are doing right now with their own reserves. It's what the ancient empires did. It's what works. Let me come back to the signal itself, because I want to be very precise about what makes this moment different from the dozen other times you may have heard that gold was about to explode. The 1971 signal was not just one thing, it was a layering. You had monetary overextension, more paper than underlying value. You had geopolitical fracture, the global order reorganizing away from the existing power center. You had institutional accumulation, the smart money moving quietly into the exit before the doors got crowded. You had physical demand outpacing the ability of the paper system to satisfy it. And you had a public that was almost entirely unaware of what was about to happen. All five of those conditions are present today, simultaneously, for arguably the first time since 71 itself. That's the signal. Not any single data point, not one chart pattern. The convergence of all five layers at the same time, in the same direction, with the same fingerprint. Let me give you a thought experiment. Imagine you are at a party, a large party, hundreds of people. The party is being held in a beautiful building, but you've noticed some things. The foundation has cracks that are getting wider. The fire exits are blocked. The fire alarm was disabled last year, and a handful of the engineers who built the place are quietly slipping out the side door. Nobody is panicking. The music is still playing. Most people haven't noticed anything. Would you walk toward the exit while it's still uncrowded, or would you wait for the smoke? Silver deserves its own conversation here, because the 71 parallel applies with even more force to silver, and yet most people focus almost entirely on gold. Silver is both a monetary metal, it has served as money throughout history alongside gold, and an industrial metal. It is essential to solar panels, electric vehicles, electronics, medical devices, semiconductors. The industrial demand for silver is growing every single year because of the energy transition and the explosion of electronics. At the same time, silver mine production has been flat to declining, and above-ground stockpiles have been drawn down to levels not seen in decades. The silver market has been running a structural deficit for 6 consecutive years. More silver is being consumed than is being produced. Every year, the gap has to be filled by drawing down existing inventories. There is a limit to how long that can continue before price becomes the adjustment mechanism. Silver is currently trading at historically low levels relative to gold. That ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been at elevated levels by historical standards, suggesting silver has significant catch-up potential. When gold moved after 1971, silver's move was proportionally larger. When gold has its major runs historically, silver tends to follow and then overshoot. For the investor who wants exposure to the monetary metal story but is looking for leverage, silver has historically provided it. But let me be clear about something. Neither gold nor silver is a get-rich-quick trade. This is not about timing a short-term price move for a quick profit. This is about recognizing a historic monetary transition that is unfolding over years, positioning your wealth correctly for that transition, and protecting what you've built from the corrosive effects of currency debasement. The people who win in this kind of environment are not day traders. They are people with conviction, patience, and a historical perspective that goes beyond the next quarter's earnings report. Let me paint one more picture for you before we wrap this up. Imagine it's a decade from now. The monetary reshuffling that's currently underway has played out. A new system has emerged, one in which gold plays a much larger formal role, whether as backing for a basket of currencies, as collateral in a new international settlement system, or simply as the universally accepted store of value in a multipolar world. The dollar is still there, perhaps, but it is one currency among several rather than the undisputed global reserve. The nations that accumulated gold aggressively over the past several years are the ones with the most leverage in that new system. The individuals who held physical gold through the transition are the ones whose purchasing power survived intact. Now imagine being in retirement in that world, with no gold, with a portfolio that was entirely in stocks and bonds and dollar-denominated instruments, with a social security check that buys fewer groceries every year because the currency it's denominated in keeps losing ground to the real cost of living. That is not a scare tactic. That is what happened to retirees in the inflation of the 1970s. It happened to retirees in Weimar Germany in the 1920s. It happened to savers in Argentina, in Venezuela, in Turkey, in country after country, in era after era. When the monetary system shifted, the people who had no anchor were the ones who suffered most. The signal that just triggered is telling us that we are in one of those pivotal moments. The same convergence of factors that existed in 1971, the same institutional behaviors, the same geopolitical fracture, the same monetary overextension, all of it is present and accelerating. Gold has already moved substantially in anticipation, but historically, the early move is just the setup for the main event. The question isn't whether you believe gold is going higher. The question is whether you understand why, whether you are positioned, and whether you have thought seriously about what the transition looks like for your specific financial situation. For those of you who have been watching this whole way through, first of all, thank you. That means you take this seriously, and you should, because this is serious. I want to give you one more resource. The free guide in the description covers the foundational steps for protecting retirement wealth in the current environment. But for anyone who watched this video all the way to this moment and who has $100,000 or more sitting in any kind of retirement account, there is something additional I want to offer. Mention that you watched this video all the way through, and you can access an exclusive, no-obligation, one-on-one educational web conference, completely free. Not a sales call, an actual educational session where you can ask every question you have about how this works, what a gold IRA looks like specifically for your situation, how to evaluate whether it makes sense, what the risks and benefits are. This is available only to American retirees with that minimum account size because, honestly, the complexity of the conversation requires that filter. It's not for everyone, but if it's for you, it's one of the most valuable uses of an hour you can imagine given the environment we're in. The last time the signal that just fired looked exactly like this, the world changed in ways that people are still talking about 5 decades later. The people who acted did not look like geniuses at the time. They looked cautious, maybe even a little paranoid. But history is written by outcomes, not opinions. And the outcome of positioning yourself correctly before a major monetary transition is wealth that survives whatever comes next. The gold window was closed once before. The second time it closes, it won't be a decision made by one president in one speech on one summer evening. It will be a process, gradual, then sudden, just like it was last time. And just like it was last time, the metal itself will be the only thing that comes out the other side with its value intact. The signal has fired. The rest is your decision.